The Sensex is down about 4.7% over the past week on news that three banks in the US have collapsed. Now the crisis seems to be spreading towards Europe, with Credit Suisse also in trouble. How serious is this crisis? Is it fair to compare it with the great financial crisis of 2008? How much further downside is there in the Indian market because of these developments? And will banking stocks in India also have to bear the brunt of this crisis? To get an answer to these questions, which are today on the minds of every retail investor in India, we spoke to Mr. Mahesh Patil, Chief Investment Officer, Aditya Birla Sun Life Mutual Fund. Do watch this interview for his answers. Good afternoon, Mr. Patil, and thank you for joining our show. We are speaking
good afternoon,
at
Sanjay.
Good afternoon. We are speaking at a time when the Sensex is down about 4.7% over the past week, and there is a banking crisis brewing in the US. Could you explain for our viewers the reasons for this crisis? Why is it happening at all in such a well-regulated market?
Yeah, so you're right. I think in the last 1 week has been pretty volatile, not only for India, but more importantly, globally. We have seen a wide fluctuation, right? In fact, the US, if you look at the 2-year bond, right, has seen a huge amount of volatility from 5%. Okay, it's gone down to less than a 4% yield on the US 2-year bond. But the reason for the challenges in the US banks, and now, okay, we've heard about in the European banks, also one of the large European banks, there was kind of a concern on that brewing over it. So this time around, if you look at, unlike the global financial crisis, right, it was more of a credit crisis, okay, which led to the problems in the whole banking and the financial services sector. This time around, I think it's not so much of a credit issue. It is because of the sharp increase in the interest rates, what we have seen, especially the US, okay, 10-year bonds, long-term bonds, where because of the US fight against inflation, the central bank, we have seen the interest rates have gone up, policy rates have gone up significantly in the last 1 year. And as a result of that, a lot of these banks, they hold securities, government securities, right? Okay, as a part of their investment book. And some of these banks had long tenure dated securities, right? And when you buy a long tenure paper, say 10-year, 20-year paper, and if the interest rate movement happens sharply, then there is a loss, okay, because of the duration risk which is there on those investments. And I think that has led to kind of some of the losses in some of these banks. And that created some kind of a concern. And whenever there is in a banks, okay, when we see large losses, investor confidence goes down, and there's a run on the deposit, especially the smaller banks. So I think that was led to the problems, okay, for the US, some of the banks which had investments into long-term government bonds, and I think that created a panic. But I think the government, US government, and the Fed has stepped in, okay, at the right time and tried to give confidence back, at least for depositors, right? So to say that, okay, they will provide liquidity to these banks on the tap, and that will ensure that there is no kind of unwind, okay, which they have to do, okay, of their investment book. And because these are mark-to-market losses, right? I mean, these are not actual, these are notional losses which are there on the investment book. So I think that backstop measure has been provided by the Fed, and that should help to contain this situation, right? Because, and since it's not a credit crisis across, we don't see that contagion actually spreading out to other banks, okay, which don't have these kind of large investments into long-dated securities.
I have one supplementary question here, and that is purely from a layman's point of view. Why couldn't they have pulled out money from long-dated securities and either moved into cash or moved into shorter-dated securities? Wasn't that a possibility? After all, these are experts handling funds?
Yeah. Yes, you're right. I think some of the very long dated securities are not okay when it is more than 10 year, but some of them could have been larger, right? 20 or 30-year listing bonds, which are not as liquid, right? And when you start to do that, okay, it creates its own pressure. And normally, I think, as I rightly said, I think one should have the risk management framework of this bank. Okay, should have. See, normally when you say government bond, I mean they are safe, right? So there's no credit, so there's no risk as such. But because of the sharp interest rate movements, it leads to mark-to-market loss onto that on that portfolio. So that is where, and I think so. So I think the banks would have thought, okay, there's a sovereign bond, right? Okay, there is no credit risk as such. There could be short-term volatility which could be there, which they can still manage it, right? But I think the risk management practices should have taken care of. I think in search of pursuit of in the earlier period, right, when interest rates were very low, short-term rates were very low. I think in pursuit of better yields, people would have parked the banks. Some of the banks parked money in these long tenure because where you got a slightly better yield than because I mean short-term rates in US year back or 2 years back were almost zero, right? So, but I think they should have tried to at least unwind some of that. Okay, so that we would have not seen this kind of situation. But every now and then we see some one or two banks, some institutions actually don't really follow the risk management practices and take a slightly undue risk, and that's what has hit. And this was bound to happen when such large movement happened in interest rate. There's somewhere you will see mark-to-market losses, okay, which could come to the fore.
Very true. Unintended consequences can always happen in the market. How serious is this crisis? Because we are reading about comparisons with the Lehman crisis to the great financial crisis of 2008 and so on. Are those comparisons exaggerated, or is there a case for making such comparisons?
Yeah, so I think, as I mentioned earlier, I mean, earlier it was more of a credit crisis, and when that happens, okay, it is much more widespread and difficult to really contain that, right? Because there's an underlying problem in the lending which you have done assets, right? And it's also related to the paying power of those lenders, okay, where whom you have lent that money to this. In this case, it was more of a liquidity problem which is there, and that has been addressed by the central banks, right, to provide that liquid backstop support to the banks. So to that extent, I don't see this problem really. What will happen is some of the depositors who have fled because of concern. Whenever there is a concern on the bank, you see depositors fleeing. They have gone to the larger banks. So it's moved from one bank into the another, and and also the fact that this. Uh, I mean, some of the smaller banks, okay, they will have to kind of slow down the operation. So the overall lending growth or the credit growth could get impacted a bit, but that will mean there will be, I mean, credit availability to some of these startups and other things which were getting that easy money, that will slow down. So that will slow down the growth in the economy, so that it has more impact on growth and slow down in the economy rather than any kind of a large contagion across the banking and financial system. Even in Europe, also where we've seen Credit Suisse, okay, which has been dealing in the problem for some time. It's nothing new, but whenever there are concerns, you see this flight of depositors, and then there's a run on the bank. That has also been taken care of. ECB has given a liquidity support of more than around $45 billion, okay, which should stabilize at this point in time. So I don't see that unless that leads into a bigger slowdown, a deeper recession in the US or in the European markets, and that leads to a credit crisis down the line. Okay, which then can be a real contagion effect. But at this point in time, I don't think so. One should be too worried about any kind of a major collapse of the banking system.
So the Sensex is down 4.7%. Is there further downside, or was this purely a knee-jerk kind of initial reaction and now the market is expected to stabilize?
So markets have been, I mean, markets can, we have seen corrections much larger than this, right? okay, when such kind of events have happened. And whenever there is a global risk off and liquidity money moves out, and there's a selling from foreign, we see markets having a deeper correction. So I think markets can always correct more from here because of liquidity issues over there, and that should not be something which one should be too worried about it, unless there is a fundamental change, right, in terms of the outlook on India or the corporate India. We don't see a meaningful change over there. So yeah, there could be some more downside. Okay, we don't know. Okay, to what extent the risk aversion, okay, will play out. How the flight from equity. What is also happening is that there is some money moving into equity, into debt now, because interest rates have gone higher, even globally for that matter, and that is also hurting markets globally. But I would say that the market is now looking at a very fair level now, right? So a year back, the markets were expensive compared to their long-term averages. If you look at the price to earning multiple was much higher. In the last 15 months, the market has gone nowhere, right? And earnings have gone up, right? I mean, earnings would have been up almost like in that period around 22, 23% or so. So the valuations are now much more reasonable. A lot of stocks have corrected. So from here on, I would say that, I mean, there is always undershoot on the downside, right, when there is a risk aversion, but the markets are no longer expensive. So given that, I don't see there should be much downside from here. I think you will see some buying support coming in, because then the market starts to look more attractive than its long-term average.
What are your earnings expectations for the coming financial year?
So the Nifty earnings growth for this year, if you look at, we have already seen now 9 months results come through. It's looking like around 13%, at least from our estimates, around 13-14% earnings growth for Nifty in this fiscal year. And next year also, we are looking at around 12% kind of earnings growth for Nifty, 12 to 13% growth for Nifty next year. The consensus numbers are slightly higher than this. If you look at the Bloomberg consensus, would be slightly in the high teen numbers. But assuming that there could be some downgrades, and now the way the economy is shaping up, I think I'm looking at global economy, I think there could be some slower down. The recovery could be slightly slower. But I think still next year also we are looking at around 12 to 13% kind of earnings growth. And it is spread across sectors. And the bigger sectors which will drive larger growth will be the banking and financial services sector, the auto sector, for example, then the consumer sector, right, which the telecom sector, where you will see or even the industrials for that matter, will be the sectors where the growth will be slightly higher than the average growth for the Nifty.
Could this crisis have an impact on the Indian banking sector? Because banking stocks have also corrected.
So I don't see any impact on the Indian banking sector per se. What has happened is, because of this crisis, the expectation on US Fed increasing interest rates, okay, more, right? Market was factoring that the policy rates, okay, will go to as high as 5.5 to 5.75, right? So that expectation is actually moderated down now, right? Because now I think the slowdown or the growth slowdown will be much more sharper or faster. So the expectation on increase in interest rates has now come down for the US. And in India, we're expecting again one policy rate increase to happen. So apart from that, so there's not much of I think should be a worry, because Indian banking sector is in a much better shape now, right? The overall margins, the net interest margins of the banking system has improved significantly in the last 2-3 quarters, because whatever the policy rates which have increases have happened, that has been passed on to the end consumer, because now the lot of the rates are now floating rate loans are linked to the policy rate. So any increase in policy rate increase your lending rate to the customers, when a deposit rate increase taking some time, the cost of fund increase is taking with a lag impact. Also, the credit, if you look at the overall credit costs in the banking system, are at a kind of a decadal low at this point in time. We are going through a very good cycle, okay, where the corporate credit costs are also very low, and on the retail book also, okay, the NPAs are after the COVID crisis, now things are kind of normalized. So we don't see any larger stress in the corporate balance sheets. In fact, in the last 3 years, a lot of corporates have delevered, right? Their debt to equity ratios has gone down, and even sectors like commodities and metals, which used to have, which were problem sectors, companies there are seeing a significant decrease in debt, and their profitability is much better. So net, I would say that the overall Indian banking sector is much better shape. The banks' balance sheets are also much better because the capital adequacy ratio, if you look at, is also fairly well capitalized across the board. The private banks and even some of the PSU banks also. So given that, I don't see there is going to be a major challenge. There could be some slowdown. So your credit growth, which was growing at around 15% or so currently, that will probably moderate down. Anyway, we're expecting credit growth to go down to around 10 to 12%, 11% next year.
And real estate is another index that has taken a hit. I think it's down 5.6% over the past week. Why is this happening?
So real estate sector is slightly more rate sensitive because with interest rates going up, we've seen that the mortgage rates have gone up, right? So they've gone up by more than 200 to 250 basis points. So your loans, okay, rate on your mortgages have gone. So as a result of that, there is, I mean, Mark believe that okay, that could have an impact on growth, right? New home sales, because uh, though I would say that we haven't seen any material impact slowdown in the real estate sector, it is still doing fairly well. There is a genuine demand which is there for actual genuine buy. It's not a investor-led demand which is driving the real estate at this point in time. So it's more to do with the higher interest rates, which is leading to a higher increase in the mortgage housing loan rates, which has impacted the sector on fears that there could be some slowdown in sales. But current reality is that the housing sector or the sector is doing reasonably well and holding on. The demand is still fairly reasonably good.
On the market cap side, large cap, mid cap, small cap, which are you more partial to, or which would you recommend to a mutual fund investor at this point of time?
So currently the market, large cap, mid cap, and small cap, I think they are fairly well balanced on a risk reward basis, right? It's not like something is very attractive or very expensive. But in the current context, when there is uncertainty and both globally, less so on a domestic side, I would say, one would slightly have a bias towards large cap at this point in time because larger companies would provide more stability there to the portfolio. But I think India is more about bottom-up story, and Indian outlook looks good. Indian macro outlook or the growth outlook for long term is fairly good, and we are positive on that. Indian economy will do well over the next 3 to 5 years, is what we think. And in that scenario, mid cap and small caps also tend to do well because they are more inward looking, domestic looking. A lot of large cap companies have also some dependence on global growth, like sectors. So longer term perspective, I think mid cap and small cap also look fairly decent over here after the correction what we've seen. So we are slightly more agnostic. So I would say that you stick to your allocation discipline of what you would have based on a risk profile towards large, mid, and small cap, and don't go overboard in any direction. But from a short-term view, I think slightly more biased towards large caps.
Which sectors are you favoring more at present? Which ones do you see doing better over the next 1 or 2 years?
So largely, I think the domestic facing sectors where you've got more, we are more positive on because where we think Indian economy will still continue to grow at around 6% or so, slightly lower next year, but overall on a potential 6.5%, and that would drive growth in various sectors, including the banking and financial services sector. Like banking sector, we are positive on. As I mentioned earlier, we don't see any major risk to earnings. Valuations are also reasonable, slightly below their long-term averages. So you're not buying them too expensive. So banking and financials are good. I mean, other domestic facing sector like consumers, for example, facing companies are also fine. I think you should see the whole commodity prices start to come down, right? And especially oil prices and this thing that should help improvement in margins, and rural economy, which has been weak, is slowly starting to improve, right? So that should help the consumer sectors. Also, in India, we've seen that the investments are slowly starting to pick up. So the industrials and the capital goods sector is seeing a decent order flow improvement. And with the whole focus on India on domestic manufacturing, the Make in India, the whole production like incentive schemes, and the China Plus One, which is driving some investments over here in the few sectors, I think the whole industrials and the capital goods sector should also do well in the coming years. And private sector capex, we see slow and steady recovery in that down the line. So that's another sector where we are positive on. And finally, I would say that the whole digital theme, right, what's playing out, right, globally, while there is some slowdown because of the US growth slowing, but that can be again a good long-term theme to play out. I think that whole move toward digitization will continue to play out, and Indian companies are well positioned to capture that. So these are some of the sectors where we are. One would take a positive view from a next 1 to 2 year perspective.
When negative market news makes it to the front pages of newspapers, retail investors do tend to get worried. Would you have any do's and don'ts for retail investors at this point of time? Are there any changes that they need to make to their portfolios in the light of the recent events?
So I think one is that I think the last 1.5 years haven't been that great. So returns are not that. You will not see much returns in your portfolio, but one should not be too perturbed by that. One should continue with your investment. If you're doing SIPs, systematic investment plan, I think one should continue to do that and not stop that. There's a tendency to stop that because your returns for the last 2 years or 1 year might not look that great. But that's the biggest mistake investors will do at this point in time, because uh, we don't know where the markets will bottom out. And so continue with that. And as I said, markets are now not looking expensive. They're more reasonably priced at this point in time. And secondly is that at the same time not to be too aggressive also, because there is a lot of some amount of uncertainty which is there. There are some risks which are there. Stick to asset allocation. There is now interest across asset classes, like even debt is now giving a decent return, right? Interest, whether it is bank FD rates are now like 7.5% or so, touching 8%. And even debt funds are offering now reasonable returns. So you balance it out and diversify, yeah, right, your investments based on a risk profile, and stick to asset allocation. Right? If you have decided this is my right asset allocation in between debt, equity, or even gold, stick to that and be in that range. I don't think one should be too aggressive. Even on equities, also, I would not suggest that you go aggressively, because the risk reward is not such compelling that you would want to do that. At the same time, it's not where you would want to be out of equities just because the last 1 year returns are not looking all that great. So stick to that, and I think over a longer term, I think equities here would still give you reasonably good returns. Okay, which is in line with the long term returns is what we believe, and for that you need to continue to invest, right, with your normal savings, whatever you have incremental based on your target allocation. I think that discipline one should continue to maintain.
Are there any specific behaviors, risky kind of behaviors that you have noticed which need to be avoided? Is there anything you'd like to point out at this juncture?
So risky behavior, I think in the past, I think we've seen that, right? When returns in a particular asset class have gone up, people have gone into cryptos and other currencies, right? Just looking at returns, past returns, and investing without fundamentals. I think that needs to be curtailed. This is the market now going forward, because there's no easy liquidity which is there. Easy money is gone. So it will be more discerning market only where the fundamentals are good. Okay, even in the equity market also, companies which are fundamentally good, where there is earnings visibility, earnings growth, where there are cash flows, I think they will only do well. I think just chasing returns will not, momentum will not really play out. So you have to be more uh, fundamentally driven, more focus, okay, on the fundamentals rather than driving, okay, by price movements, because I think that if you follow that discipline and don't take risk beyond that which you don't understand, I think you should be fine.
One final question on the SEBI website where new fund offers that will shortly hit the market are listed. I saw that ABSL has about 7 target maturity funds. Are you very bullish on this category?
So target maturity fund is something which we started promoting around, last year in a big way, because we saw that there was a reasonably good return, okay, which you could get without taking too much of a risk, investing into sovereign bonds, right, especially the SDLs. And if you are targeting your investment horizon, right, then there is a less amount of interest rate risk which is there. This was a time when the other rates, short-term rates, were very low. But and if you take the benefit of taxation when you hold them for 3 years, and these are typically we would want to there for 3 to 4 year period, right? Okay, there are different durations which are there which you can play out depending on an investment horizon. Then on a post-tax basis, the returns were looking fairly attractive, because in when you invest into mutual fund in these in the target maturity funds, you get the long-term capital gains tax, right, which is for debt is around 20%, and you get the indexation benefit. So your overall tax rates goes down. So compared to say FDs and other instrument, I think on a post-tax basis they look attractive. So that's the reason why, okay, we thought they were interested, and they saw good attraction from investors, and I think still continues to look to be a reasonably good investments for investors who are trying to really not take much of a risk, and looking at assured, not assured, but kind of a return which is more expected lines, provided you stick to the investment horizon, you hold on to those instruments, okay, for that duration which you are looking at. I mean, there are 3 year, 4 year, 5 year target maturity plan which investors can take as per their investment horizon and needs.
I have finished with my questions, Mr. Patil. Would you have any final words for our viewers?
So I would say that we are in a peer environment, okay, where there's a lot of uncertainty, which is there, too much volatility. I mean, one would have never seen this kind of volatility interest rates, right, sharp. So, but I think across asset classes, whether it is gold, equity, debt, and gold, we are seeing reasonably return. We're not seeing any big returns. So stick to your diversification, okay, diversify across asset class, uh, even gold for that matter, right? Based not too much, but okay, just to diversify, I think can be looked at, and stick to the discipline. I think don't be too pessimistic, okay, in the market. Also, I think at this point in time, because things might look gloomy, right, from everywhere, negative news flow is coming in, and there's an opportunity really to really actually invest into equity, I would say. So if you stick to your discipline, asset allocation, and don't get swayed, I think one should be fine. And this is not a time to take undue risk anywhere. And that's what my message will be to all the retail investors.
Thank you, Mr. Patil. I'm sure our viewers will gain much from this interaction. The key takeaway being that don't let recent events perturb you unduly. Stick to your asset allocation and stay invested in a diversified portfolio. Thank you very much. It was a pleasure speaking to you.